Welcome back to CrowdWise Academy. This is Brian. You're here in the Startup Investing 101 course and kicking off Level 2, Early Stage Investing. In today's lesson, we're going to be talking about what is early stage investing. So, as a reminder, we also have Level 1 courses which provide a great introduction of equity crowdfunding and investing fundamentals. You're part of the Level 2 intermediate courses currently, and we're in Module 1 going over risks and returns. And we also have some Level 3 advanced courses that talk specifically about due diligence, screening, selecting deals, and making your first investment. An overview of what we're going to be covering today. First, we're going to talk about the startup lifecycle. Pre-seed, seed, Series A, B, what are all these rounds and what do they mean? We'll be talking about that. Also, we'll be talking about failure rate statistics of startups by phase. We'll talk about the types of investors that get involved in each phase. And then we'll also talk about early stage exits, which is where investors get their money in the private markets. So, before jumping into any of this, I think it's important to define what is a startup. There's so many different interpretations out there, and everyone has a different idea when they hear the word startup of what we're talking about. Our favorite definition is that a startup is a company working to solve a problem where the solution is not obvious and success is not guaranteed. This is from Neil, the co-founder and co-CEO of Warby Parker, but we think it's very applicable to the use of the word startup throughout all of our educational material. Now, this definition could technically apply to maybe any business out there, since nothing is certain. However, we think it's most applicable to all those private market businesses that are still trying to prove themselves. And so that is the definition that we'll be using whenever we refer to a startup. Now, when we talk about the startup lifecycle, we can walk through each phase and get an idea of where a business is and who the types of investors are that get involved. First, there's the 3Fs round, which some people refer to as founder, friends, and family, or friends, family, and fools. This is also very early with a pre-seed round. Now, the product maturity at this point in time is usually just a concept or a sketch on the back of a napkin. So it's an idea, but the company probably doesn't have an actual product yet on the market. Now, typical raises are typically well under $1 million, and valuations in the pre-seed rounds typically run $1 to $3 million. Now, once a company moves on to raise the next round, a seed round, they're starting to get something called an MVP, or a minimum viable product, and prototypes out. They're trying to test their product or idea to see what sticks and to see if customers like it. Now, typical raises can range anywhere from, say, $150,000 for angel seed rounds, all the way up to $2 million plus raised when venture capital gets involved. Typical valuations in seed rounds can range from $3 to $10 million, but again, these are typical, so you will see numbers that are outside of these ranges. Now, once a company has something that they believe has found something called product market fit, the business is ready for a key transition. That transition occurs during the Series A round, when they are taking their product that has found some traction and adoption in the market, and now look to scale it and get it out to as many people as possible. This is like pouring fuel on the fire once the fire is going and you know you have something that can grow. Typical raises in the Series A round range from $3 to $12 million, with valuations ranging from $10 to $30 million. Typically, venture capital is much more involved around the Series A, although you'll still have some angels investing in follow-on rounds or for the first time. After the Series A transition, companies can go on to raise Series B, C, D, and there's really no end to the letters. Now, all the letters indicate that it's still a private company, but all of those later rounds are essentially important for the reason of trying to make their product work at scale. The typical raises for Series B and onward rounds can be anywhere from $10 million and up, with valuations in the $30 million range and up. Now, after all these private market rounds, a company may decide to go public. At the point that a company goes public, it has probably developed diverse revenue streams. So instead of just one product or service, it has many different diverse offerings that all provide revenue for the company. Typical raises when going public are around $111 million, according to 2018 data, with post-IPO market caps of about $515 million. Market cap is essentially the public version of valuations in the private market. So when we talk about early stage, what we're really referring to are the boxes shown in green. Now, regulation crowdfunding, which allows up to a 1.07 million raise, is usually a good fit for companies raising in that area. After Series A, that's typically what is referred to as growth or later stages. While Reg CF can still be involved, typically businesses will be looking to raise higher amounts of money, and so Regulation A+, which allows up to a $50 million raise, is more applicable. Reg A+ is also known as a mini IPO, where you can publicize it to investors, but without some of the stringent requirements required of going formally public. Each of these different phases also attracts different type of private market investors. So, if we plot those phases again on the x-axis, early stage, Series A during the transition, to growth late stage, and then IPO public, that can be our axis of time. In the early stages, it's typically angels that get involved. As we mentioned, angels will still invest in Series A and beyond, but they are really important for startups at the beginning. Venture capital is the next to get involved. They typically come in around Series A, but there are definitely venture capital firms that both focus more on the early stage as well as others that go later into the growth or late stages. Later on in the startup life cycle, private equity gets more involved. This is when the startups are becoming much larger and getting ready to go public, so private equity firms will buy controlling ownership in order to take the companies public. Lastly, through either an IPO, initial public offering, or direct listing, companies can go public, which provides an exit for their investors. So essentially, anything after this line to the right is public, while everything to the left is considered a private market. Shown again here, we can see where Reg CF, regulation crowdfunding, and Reg A+ come in. Now, Regulation CF can technically be used at any point, but because of that 1.07 million cap, as companies get more mature in the later stages, they will probably rely more on the larger limit of Reg A+. It's important to note some of the differences between early stage and later stage investing. It requires a different set of skills, not only for the founders, but also for the investors. Typically, there's different screening processes for each as you're looking at different metrics. Each has a different potential return profile, as well as different risks. And so, the primary focus of CrowdWise is going to be on early stage investing and Reg CF. However, we will get a little bit into the later stage investing, as well as Reg A+, since those offerings are also shown on the same equity crowdfunding portals. A common statistic that many people hear is that 8 or 9 out of every 10 new businesses will fail. Where does this come from? Well, one reference that looked at some data on Crunchbase broke out the failure rates by phase. With the phases on the left, you can see in the middle column what percentage of those companies failed to raise a following round, and on the right-handmost column, which percentage of companies failed to exit at all for their investors. You can see that the failure rate for exit goes from 97% from seed stage, decreasing down to 72% for Series G. Now, these are averages, but you can see that all this taken together, there's an overall average of 81% fail to exit. And that's probably a good approximation of where the saying is that 8 out of 10 startups will fail. We'll be looking more at failure rate data in a later lesson. Another important topic to understand in the private markets is exits, or how investors get their money back. Assume that there is a car on a highway, and that car represents the startup that you're investing in. Now, as the investor, you're going to be giving that car fuel so that you can get it going at the beginning. So initially, there'll be an injection of capital, which is that pre-seed or the 3F's money early on, and that really gets the startup rolling. But again, to keep that startup going, they need to raise seed rounds, and then typically Series A, B, and so on and so forth. Now for investors, imagine that there's different exits along this road, and in order to get your money back from your investment, you have to get that startup to take one of those exits. What are the different ways that investors can get liquidity or get their money back? First, the startup could be acquired by a company early on. This is usually an early exit, and as we know from the internal rate of return IRR calculation, getting your money back in a shorter time boosts the essential IRR rate that you get for your money. Next is something called a buyback. A buyback is when a shareholder or a company reacquires stock from the other shareholders. Now typically, the founder or the company will have a positive attitude about its future, since by buying it back, they're getting a larger share again of the ownership. Third, there are secondary sales. Secondary sales are similar to a buyback, but it's when you sell your shares to any other investor on the secondary market. So it's not during a formal seed, Series A, or Series B round, but it could be a negotiation at any point in between. Note that secondary sales and equity crowdfunding are still very limited under Reg CF. There's typically a 1-year holding period where you can't sell your shares in any Reg CF investment, except to an accredited investor or some other exceptions. However, secondary markets are still under development in 2019, and so investors in Reg CF should not depend on this as a potential way to get their money out if needed. One of the most popular exits for early-stage businesses is via a large acquisition. This is when perhaps either a competitor or a large company acquires the company and adds their product or service as part of their own offering. Large acquisitions are a large part of the positive exits for startups. And last but not least, the holy grail for investors is the IPO, initial public offering, or direct listing when a company goes public. Note that the exits here are not necessarily intended to match up exactly as shown along the timeline with the different funding rounds. They can occur at any point in time. However, it's good to visualize here that the company needs capital to keep bringing it to the next potential exit. That's where the term runway, which is essentially the number of months left that a business can go with the cash that it currently has before it has to raise money again. So we've talked about some positive exits, but what about bad investor outcomes? First, there's something called the acqui-hire. This is a combination of acquisition and hire because the business is acquired, but is primarily for its talent or intellectual property, IP, and thus it likely returns little, if any, to the investors. Next is something called the zombie, or the living dead. This is a business that doesn't fail, it may even be cash flow positive, but the growth is too slow to attract any potential buyers or provide exits for its investors. Thus, their money is locked up in this undead business and they can't do anything about it. Third is dilution, or what I refer to as death by 1,000 cuts, i.e. funding rounds. This is when the business continues to raise money, but perhaps at equal, small, or even down valuations, and each round further dilutes your initial holding, which erodes your returns over time. Lastly, when you think of failure, it's probably outright failure, such as bankruptcy or dissolution. This is simply when that business or startup runs out of fuel, and thus they have no more cash to continue on or just give up. That wraps it up for today's lesson. So what can you expect in the next lesson? We're going to be talking about how most investors misinterpret the risk-return curve, an introduction to private market risk versus returns, systematic versus non-systematic risk, and how to mitigate it in your portfolio, and early-stage failure rates. Thanks again for watching today's lesson. We'll see you back here for lesson 2.